pension crisis and the importance of personal planning. In many developed countries, state pension systems are under immense pressure due to aging populations and declining birth rates. For example, countries like France, Japan, and Italy are facing long-term sustainability challenges with their pension models. As a result, younger generations may not benefit from the same level of retirement support as previous ones. Meanwhile, those who took personal responsibility, investing early in diversified portfolios, using retirement accounts, and regularly contributing to long-term investment plans are often far better positioned for financial security. This chapter lays the foundation for building that kind of resilience, understanding why relying solely on external systems is not enough, and how to take ownership of your financial future. A pension is a regular payment made during retirement from an investment fund into which an individual or their employer has contributed. In many systems, this is managed by the state or a corporate pension plan. However, over-reliance on government or employer-sponsored plans can be risky. Demographic changes, rising inflation, and underfunded systems make it essential to develop your own personal strategy to supplement or eventually replace these pensions. Despite its importance, personal finance is often not taught in schools. As a result, most people don't understand compounding, lack clarity on saving versus investing, and rely on banks or advisors without understanding their incentives. Taking control begins with education, learning how money grows, how markets work, and how to assess your own risk appetite. Relying entirely on advisors or pension funds can lead to disengagement and poor long-term outcomes. Delegation model: outsourced decisions, limited understanding, potential conflicts of interest. Ownership model: active involvement, better alignment with personal goals, increased resilience during market shocks. You don't need to become a professional trader, but you do need to understand what you own and why. A long-term portfolio isn't about beating the market next month. It's about building and protecting wealth across decades. Focus on growth with controlled risk, diversified exposure to various asset classes, automatic reinvestment of income, periodic rebalancing. Your goal is to ensure financial independence regardless of macroeconomic or political conditions. Don't rely solely on government or employer pensions. Understand the core principles of personal finance. Shift from passive delegation to active ownership. Think long-term because your portfolio is your future income. In the next chapters, we'll learn how to build a globally diversified portfolio and manage risk effectively. In the early 2010s, European investors faced extreme volatility due to the sovereign debt crisis. Countries like Greece and Spain experienced sharp market declines, with banking sectors losing over 50% in value. However, investors who had diversified globally, holding exposure to US tech stocks, emerging market bonds, and Asian equity indices, were far less impacted. Some even saw gains from US equity rallies during the same period. This real-world scenario illustrates that regional risks can be mitigated with global diversification, helping long-term portfolios weather local storms. Global diversification is the practice of spreading investments across various regions, industries, and asset classes. Rather than concentrating on a single country or sector, you gain exposure to different economies with distinct growth drivers and risk profiles. Risk reduction. Different markets respond differently to crises and cycles. Exposure to growth. Access high-growth economies outside your home market. Currency diversification. Hedge against inflation and FX risk in your home country. Return smoothing. Gains in one region can offset losses in another, reducing portfolio volatility. Sectors: technology, healthcare, financials, energy, consumer discretionary. Regions: North America, U.S, Canada. Europe, Germany, UK, France. Asia, China, Japan, India. Emerging markets: Brazil, Indonesia, South Africa. Each geography has strengths and weaknesses tied to political stability, innovation cycles, regulatory environment, and currency dynamics. ETFs, exchange-traded funds, diversified low-cost exposure to global regions or sectors. Mutual funds, actively managed options with global mandates. Global index funds, track indices like MSCI World, FTSE All World. ADR/GDR listings, buy foreign companies listed on your home exchange. ETFs are particularly popular due to transparency, liquidity, and ease of use. Home bias, overweighting your local market out of familiarity. Overexposure to USD or Euro assets. Even if globally diversified in companies, currency exposure matters. Neglecting rebalancing. Without regular review, portfolio weights can shift drastically over time. Diversification works best when it's intentional and maintained with discipline. Think globally. Invest across regions and sectors. Use tools like ETFs and index funds to gain efficient access. In the next chapter, we'll examine the role of cash and dividends in supporting long-term stability and passive income generation. During the 2008 global financial crisis, and again during the COVID-19 market crash in 2020, portfolios invested in dividend-paying companies fared significantly better than pure growth portfolios. For example, US companies like Johnson & Johnson, Procter & Gamble, and Coca-Cola, known as dividend aristocrats, not only held their value better, but continued to pay consistent dividends through the downturns. These companies demonstrated the value of steady cash flow and long-term resilience. Investors who reinvested dividends during those dips saw faster portfolio recovery due to compounding effects. Dividends are regular cash payments made by companies to shareholders. They are a key component of total return, particularly over long periods. Benefits include stable income stream, reinvestment opportunity, signal of company strength and maturity, reduced portfolio volatility. Cash isn't just for emergencies, it plays a strategic role in providing liquidity during market downturns, allowing rebalancing into undervalued assets, serving as dry powder for new opportunities. Typical allocation to cash ranges from 5–15% depending on age, risk appetite, and market conditions. Dividend growth investing focuses on companies that consistently raise dividends. High-yield dividend investing targets companies with higher current payouts. Dividend ETFs, Vanguard Dividend Appreciation ETF VIG, iShares Select Dividend ETF DVY, Spider S&P Dividend ETF SDY. These ETFs offer diversified exposure to dividend payers with varying risk-reward profiles. Reinvesting dividends can significantly accelerate portfolio growth. Example: $10,000 invested in dividend stocks yielding 4% with annual reinvestment could grow to over $21,000 in 18 years, assuming 6% annual capital growth. Many brokers and ETFs offer automatic dividend reinvestment plans, DRIPs, which automate the compounding process. High dividend yields can indicate financial stress. Companies may cut dividends during downturns. Overconcentration in income stocks may reduce capital appreciation. Balance is key. Use dividends to enhance stability, not as the sole strategy. Dividends provide income, cushion volatility, and support long-term growth. Cash offers flexibility and resilience. Combine dividend-paying equities with growth assets to create a balanced, compounding portfolio. Next, we'll explore how to hedge your portfolio against short-term risks without compromising long-term goals. During the March 2020 COVID-19 crash, while global equity markets plunged, US Treasury bonds and gold surged. Investors flocked to these safe haven assets, which helped cushion losses for portfolios that included them. A balanced portfolio with even a modest allocation to treasuries or gold experienced significantly less drawdown and recovered faster than all equity portfolios. This demonstrated the value of having uncorrelated assets to hedge short-term risks. Hedging involves reducing the risk of adverse price movements by adding counterbalancing assets or instruments. In a long-term portfolio, the goal isn't to eliminate all risk, it's to limit short-term shocks that can force irrational decisions or liquidity issues. Market corrections or crashes, inflation or deflation shocks, geopolitical events or elections, interest rate spikes, currency depreciation for international investors. A. Government bonds, especially US Treasuries and German bonds, tend to rise when equities fall. B. Gold and precious metals, store of value during systemic crises, offer zero correlation with stocks. C. Volatility products, for example VIX ETFs, spike during market panic, useful for tactical hedging. D. Put options or protected puts, provide downside protection on specific holdings or indices, useful for event-driven hedges. E. Currency hedging instruments, FX forwards or ETFs that hedge international exposure. One of the most effective forms of hedging is through thoughtful diversification. Equities from different regions, a mix of asset classes, bonds, real estate, commodities, currency and sector diversification. This approach smooths out volatility and reduces reliance on timing-based protection strategies. Most hedging strategies come with a cost, for example, option premiums reduce returns. Overhedging can suppress long-term growth. Hedging should be strategic, not emotional. Best practice, use hedging sparingly during times of elevated risk or when nearing financial goals requiring capital preservation. Hedging isn't about fear, it's about preparedness. Combining passive diversification and active gold, bonds, options techniques builds resilience. In the next chapter, we'll dive into asset allocation frameworks and how to construct your personal mix of growth, income, and protection assets. For decades, a classic 60-40 portfolio, 60% equities and 40% bonds, has served as a model for balanced investing. During periods of market stress, the bond portion often cushioned equity losses, while equities drove long-term growth. Although evolving macro conditions may challenge this model, the core principle remains. Asset allocation is the most powerful lever in controlling both risk and return across an investor's lifetime. Asset allocation is the process of dividing an investment portfolio across different asset classes, such as stocks, bonds, cash, real estate, and commodities, based on the investor's risk tolerance, goals, and time horizon. It is the single most important decision in long-term investing, accounting for more performance variation than security selection or market timing. Equities. High return potential, volatile, ideal for long-term growth. Bonds. Income generation and capital preservation, lower volatility. Cash. Liquidity, no growth, vulnerable to inflation. Real estate. Inflation hedge, income through rental yields. Commodities, for example gold. Crisis protection, non-yielding, volatile. Each class behaves differently in various economic cycles, which is key to diversification. Conservative portfolio. 20% equities, 60% bonds, 10% cash, 10% gold or RE. Balanced portfolio, classic 60-40s. 60% equities, 35% bonds, 5% cash. Growth portfolio, 80% equities, 15% bonds, 5% alternatives. All-weather portfolio inspired by Ray Dalio. 30% stocks, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, 7.5% commodities. ETFs, exchange-traded funds, efficient, low-cost exposure across asset classes. Index funds, ideal for long-term passive investing. Target date funds, automatically adjust allocations as you near retirement. Model portfolios and robo-advisors, pre-built and rebalanced portfolios for various goals. Multi-asset funds, professionally managed solutions with built-in diversification. Portfolio weights change over time due to market performance. Rebalancing involves restoring target allocation by selling overweight assets and buying underweight ones. Rebalance frequency, quarterly, semi-annually, or based on threshold bands, for example, 5% deviation. Review annually or after major life market changes. Asset allocation is your blueprint for wealth creation and risk control. There is no perfect mix. Tailor it to your goals, income needs, and investment horizon. Use diversified instruments like ETFs and disciplined rebalancing to stay on track. Your portfolio is your plan for financial freedom. Build it with intent, monitor it with discipline, and trust it over time.